slow China down and the world slows down. So, for some weeks now, you've probably come across some content referencing the downfall of China's entire economy, how it's positioned to collapse soon, and why their debt crisis is spiraling out of control. But China has managed to do the unthinkable by lowering interest rates and injecting even more money into the economy as a last-ditch effort to stay afloat a little bit longer. See, not only are they experiencing one of the worst housing bubbles in history, but their economic slowdown has already begun to impact the rest of the world. And there are some serious implications for all of us that you should be made aware of, because it's not a matter of if it's going to happen, but instead when that is something that needs to be addressed. Okay guys, before we go further, if you wouldn't mind doing me a quick favor of hitting the like button and subscribing to the channel, it would help out tremendously. So thank you guys so much, and now with that said, let's begin. Alright, so up until recently, China was on an unstoppable trajectory set to overtake anyone or anything that stood in its way. That's because for the last 30 years, China has been at the forefront of productions, international investment, and rapid productivity, all because of an exchange that occurred back in 1979, which gave China diplomatic relations with the United States and by extensions, the rest of the world. Members of the World Trade Organizations allege that China has been providing legal state subsidies to business that export their products, discriminating against companies that don't buy from Chinese manufacturers, and controlling supply chains through taxing raw materials. Even worse, it's said that they have been devaluing their currency by as much as 40% as an incentive for other countries to be able to buy their goods at a discount, leading, of course, to economic growth that was largely unsustainable and was going to collapse at any year. As you know by the saying, the higher you climb, the harder you fall. Well, nothing describes that better than the current state of China's economy, which is quickly becoming a victim of its success with a ripple effect that's starting to be felt throughout the entire world. But first, we have the impact of a zero-COVID policy. This quite literally means that there's no tolerance for the spread of COVID to the point where China will enforce strict lockdowns, maintain tight regulations, and do anything in its power to prevent the populations from becoming infected. But it has begun to already take its toll. So at this point, let us look at some of the myths or facts surrounding the economic crisis that China is currently facing. The first myth is that China is shunning foreign investment in its economy. This myth has emerged in part due to spats between the United States and Chinese regulators over disclosures linked to the delisting of Chinese companies on overseas stock markets. It also reflects concern about potential Chinese industrial espionage and intellectual property rights violation. The reality is that capital market segmentation is more unilateral. The United States and Europe are making their capital markets less attractive for Chinese companies. But China is not adopting a similar strategy with respect to inbound investment. In fact, in recent years, China has reduced the number of restricted sectors, industries, and firms eligible for foreign investment and foreign ownership, with the latest reductions announced last month. Last year, for example, major US investment banks were given the green light by Chinese authorities to open custody businesses and to have 100% ownership of their onshore investment banking operations. Another one is the effect of the zero-COVID policy. Chinese stocks have experienced the worst quarter in years. Their economy has begun to lose ground as global recession's fears increased supply chains have continued to be severely impacted by a backlog of shipping, and their growth is expected to be non-existent. Not to mention, these policies are so strict that all citizens must use a home code app that dictates who can move around the capital and where. If your health code turns red, you'll face isolations along with anyone you have come into contact with, who also can be deemed as high risk. These obligations made their daily life a constant challenge, compounding even further. Also, the third nail in the coffin is the China debt bubble. From 2014 to 2018, China's debt inflated by 20% annually. Housing prices are near twice the levels that led to the great financial crisis of 2008. And China continues to list lending requirements to ensure that growth is maintained at all costs, even at the expense of the global economy. But in terms of what we are dealing with today and how this could lead to potentially another ticking time bomb. So here's what's happening right now. As I mentioned earlier, that in response to slowing growth, a declining property market, and falling demand, China did the unthinkable by lowering interest rates to help stimulate more growth, while at the same time pumping $60 billion into the financial system as a way to incentivize lending. However, they reassure everyone that the government won't roll out massive stimulus measures or flood the financial system with too much new money, and would instead aim for stable prices and a relatively good economic performance. However, that doesn't exactly pair well with the reality that growth estimates have been revised down and zero-COVID policy has taken priority. leaving China with an economy that now has even more room to fail their president, who is expected to maintain a third term in power. Recently, he came on record to say that he would rather temporarily influence little economic development than to risk harming people's life safety and physical health, especially the elderly and children, while others worry that this is simply a scapegoat to avoid the much deeper issues of economic instability, like the fear of spending money. See, a growing economy wants people that feel comfortable enough about their finances to buy more products, spend more money, borrow against their assets, and be able to reinvest into growing infrastructure. But with China's weakening outlook, more and more people are holding back, creating a self-fulfilling prophecy. The prices are falling because people are not spending enough money because prices are falling in. That just repeats itself. Another myth is that China is rebalancing its economy away from investment underpinned by high savings and manufacturing towards consumption and services. In truth, China is working towards rebalancing but hasn't yet made the necessary progress. To some extent, China's policymakers face a chicken and egg problem. They understand that excessive investment, above all in property, is inefficient, but they also aim to deliver high GDP and employment growth, which investment and construction duly deliver. China is unwilling to sacrifice high growth and job creations even temporarily, which makes it difficult for them to wean the economy of its current foundation. To be sure, the blueprint is plain. China must boost consumption as a share of GDP as it reduces savings and investment. But increasing consumption is not trivial, lacking education, retirement, and other social safety nets common in advanced economies. Chinese households steadfastly save. Moreover, China's stated objective of dual circulations boosting consumption and export to offset lower investment poses its challenge. Stronger consumption requires higher wages and a larger share of labor income in GDP. Yet, China's exports competitiveness and profitability in its traded goods sectors would be eroded by that very outcome. In short, while China aims to rebalance its economy, it may take considerably longer to achieve than many expect. And finally, in a weird way, China is going into an economic recession. China's slowing growth and global recessions could help ease demand and upward price growth, meaning with fewer resources being consumed, inflation could begin to subside or even decline. A lot of these are very broad assumptions without a definitive timeline for when they could unfold. But it is a very worrying sign that we're not going to know the full effects of what's to come until most likely it's too late. We have to come to the end until most likely it's too late. We have come to the end of this video, guys. Thank you so much for watching. If you enjoyed watching this video, please do well give this video a thumbs up and don't forget to hit the subscribe button.